Ladies and gentlemen, it's a pleasure and an honor for me to introduce our next keynote speaker, Mr. Gerard Korteweg. Mr. Korteweg was initially born in 1946 in Voorburg in the Netherlands. He did his initial degree in economics, monetary specialization, at the University of Amsterdam in 1975. From 1975 until 1984, he was an economist in the domestic monetary policy departments and subsequently senior economist in the international monetary affairs departments in the Directorate of Finance. Then, from 1984 until 1988, he was the deputy head of the Monetary and Economic Policy Department, heading the Monetary Policy section at the De Nederlandsche Bank, and heading the Clinical Analysis section from mid-1994. From 1998 until 2007, he was head of the Euro Area Macroeconomic Developments Division in the DG for Economics at the European Central Bank. From 2007 until 2011, he was senior advisor to senior management at DG Economics at the European Central Bank, as well as being in charge of the analytical agenda of the DG Economics. In addition to this, from roughly March until September 1993, he also served as advisor to the Reserve Bank of Zimbabwe, counseling the introduction of a market-oriented conduct of money market and monetary policy. So really a man of a lot of experience within the Eurozone and outside. And for many reasons, we really look forward to your lecture. The topic that Mr. Korteweg has chosen is From Market Economy to Market Society and the End of Democracy, Lessons to be Learned. If you could please join me in a very, very warm welcome for Mr. Gerard Korteweg. Thank you.
Thank you very much. Good afternoon. I first have to apologize. I have a PowerPoint presentation that is very, very simplistic. It's only 3 or 4 slides, and you will have to do it with what I tell you. I was preparing more, but since I was still thinking what is now the speech, I didn't have the time to put it all down nicely in an overview. I have also changed the title a little bit. It ends now not with lessons to be learned, but whether the end of democracy is really nearing. Of course, you understand that this is only, say, an indication of where we might be moving. Of course, the chances that countries will dispense with voting and elections and so on is rather minimal. The trend is happily enough the other way around in the world. Well, I've been introduced. Thank you very much for well, getting my relatively simple history, economist, monetary, macro, and central banking, of course. What is my subject? I mean, there I have to explain a bit, I believe. How did I interpret the title of this symposium, which is Political and Economic Inequalities, how to bridge the gap between social society and the public and the private sector? Well, I took the civil society to be the democratic society and interpreted the political and economic inequalities as the risks to that society. The gap to be bridged is more or less the one reflected in the general discontent of electors in many countries and, for instance, in the Occupy movement that has been mentioned already in this morning. But I will not be very international in a sense. I restrict myself to developments in the advanced industrialized service economies, and that put me a little bit at variance with the subject of corporate cultural responsibility and corporate cultural diplomacy, of course. Nonetheless, I hope this will be interesting. The main message is economic inequality will go on increasing as a consequence of the fundamental driving forces of the market economy and of the absence of a value system inherent to the market economy and the market philosophy, and a value system other than that of the homo economicus, as we could call it according to Erasmus. I don't know the English pronunciation of that. Regarding the functioning of the democracy, the problem is not only political inequality, but also the ongoing erosion of the necessary conditions for a well-functioning democracy. I will go a little bit into lobbying and the dysfunctional information provision by press, radio, television, and others, and a little bit about academics. To preempt misunderstanding, what I'm trying to do is to attempt to understand where we are, how we got there, and where we probably will go on the basis of the driving forces identified. I use the word market society, which when I submitted the title of my speech, I didn't yet see a book of Michael Sandel called What Money Can't Buy, which also uses the term market society, and I think in a much more appropriate way. And I was, well, it's say a kind of a parallel what is described in this book. It's an, to me, rather unbelievable and frightening account of how market thinking has encroached upon almost any aspect of life in the last 30 years. It's quite interesting. But okay, I'll go to the, I'll build. So, yeah. Market economy, fundamental driving forces resulting in and the resulting long-term trends. Internal driving forces inherent to the market economy. There are two, to my opinion. And the first is competition and the uncertainty it entails. Second is customers' freedom of choice and the uncertainty that entails. Competition. Competition, the essence of competition in my mind is stay ahead or be dead, to put it simply. How do you stay ahead? You innovate and you become more efficient. Both of that you need technological improvements, innovations, and of course technological development has been the source of economic growth and affluence and prosperity. And cost reductions are an essential part to produce also productivity increase. How do businesses reduce the uncertainty produced by competition? Effectively, that is, try to get at market domination. Increase your market share, reduce the number of competitors by mergers and acquisitions, or underpricing them. If all that doesn't work, you can collude, but of course then there is antitrust law to stop that. But the uncertainty is better dealt with if you are big in your market than if you are just a small one that can be, say, put away by the number of others. And both innovation and technological development also require funds. The bigger you are, the more funds you have to develop things, and you have economies of scale there very clearly. So that is one of the driving forces to get to bigger companies, bigger business. Customer freedom of choice and the uncertainty it entails. What is the problem of a business? You first have to inform your potential customers that you're there and that your product is there. This is advertising budget. You need then to convince them that your product is superior. Again, advertising. You need to know what the customer will like. That is research and development. All three of those work better and more effectively and are more efficient in terms of what you get per euro or dollar or whatever currency you use if you're bigger and covering bigger markets. Uncertainty about customer loyalty. Of course, customers can choose to go somewhere else. There is a kind of a tension between customer loyalty and competition between businesses because the competition tries to get your customer away and you try to get your customer away from your competitor. Also there you see that the bigger the company, the greater this tension becomes because you're more vulnerable in the end. For that you also need financial buffers. The reductions of risk there is diversification and market presence, which is again dominating the market. Grow bigger and to get sufficient financial buffers, which comes with a bigger turnover, bigger cash flows and all that, and in the end to achieve market domination. Again, it will be the aim and will help to reduce those risks. The resulting long-term trends are ongoing strong technological and innovative development, which produces, of course, growth, as said, but also threaten, and we'll come back to that, crowding out of human labor. Risk limitation is the second, and all this leads to business concentration, bigger and fewer, and that is what the market economy in the end, will go to as the, say, natural reactions to the challenges that businesses are confronted with in terms of competition and customer freedom and the uncertainties that follow from them. Then we have, of course, in the more recent decade, globalization, which all reinforces all those driving forces. You have increased competition pressures, you have increased size of markets, so you can grow bigger. In a bigger world market, you have more of possibility than if you stay within your own smaller country. And so this reinforces these fundamental trends. That is to put a bit the background. Then we go to the income inequality, main determinants, the intermezzo I skip, determinants of salaries at the top, which is an interesting one, I think. In the symposium title is talk about income inequality and wealth inequality. I only talk about income inequality as the two go more or less automatically together. They reinforce each other back and forth, and the source of most wealth accumulation is in the end income accumulation, depending on your definition of income, of course. There are three main determinants of income equality according to OECD study that I base myself on now. Wages and salary are the single most important one. Then you have education, which is an underlying long-term determinant. Then you have more recently, explicitly, the factor computerizations and innovation technology, which works to replace jobs at the bottom, from the bottom upwards of the wage and salary structure. The further computerizations and innovation go, the greater the possibilities to have computers and robots and a combination of both and what have you do the jobs of that were done before by no skills, lower skilled, and ever higher skilled people. The wage and salary differentials that we have in this way reflect indeed, according to economic theory, and I think in reality, productivity differentials, and of course also supply and demand developments. The essence of a cost factor of wages of labor in a market economy, of course, that it's a cost factor. We'll come back to that. Looking forward, there are researchers who see coming an ongoing compression, which already can be measured, of the wage and salary structure because of the computerization and innovation technology. Of course, their additional education efforts would be the countering force, but it's not clear, at least from if you take the market, if you expect the market to provide that, how that would happen. So we have wages and salary structures reflecting productivity differentials, but then we get to the question, how is this going at the top? First of all, who's at the top? I'm not talking about artists and sports people and the outliers under entrepreneurs like Bill Gates and Steve Jobs and things like that, but just top of the business sector. C and other EOs, so to say. In the early stages of the market economy, this was rather simple. Nowadays, it's a little bit more complicated. I will discuss shortly, if I still can, 3 stages of historical development. You have the original entrepreneur who was the owner, the manager, capital was his capital, and then came the stakeholders, the shareholders, and the current situation is that you have a the manager, the top management, you have a supervising board, and you have the shareholders. Now, how was the remuneration done in the original state where you only had, say, the one person owner entrepreneur? He was fully entitled to the operating surplus, the profit, and he had 3 functions. The entrepreneur, that is the person who has the idea, what should be done, who takes the initiative to put it in motion. He was the manager of the production process when it's in place, and he provided himself the capital to be invested in all what was needed to make it happen. And in the 3 functions cannot be distinguished in terms of how to determine what was the remuneration for the entrepreneur, what was the remuneration for the manager, or for the same person in terms of his capacity as capital provider. Then the second is the shareholder enters. There you get that they share the entitlement to the total profit, and so you have one who is the entrepreneur manager and he has capital brought in, and you have the others. Now, of course, in terms of share of the capital, one would expect in a limited company with shares, also the owner would get his share of, according to how many, what part he has in the capital. But no doubt, he was also remunerated on top of that for his entrepreneurs and managers' efforts. Now the question is, how much would that have been, and how was it determined? I've not come further than to assume that it was determined on the basis, by the shareholders, of course, the owners, what was just judged to be reasonable. And in early times, of course, shareholders were themselves very often entrepreneurs, owners of their own businesses. And so they knew more or less what it was to run a business, to set it up, and so they knew what they would, between them, say, well, this is what you get for that, for the rest we share as capital owners. Now we come to the modern situation where the functions originally united in one person have been split up. You have top management, which nowadays effectively is the entrepreneur and the manager of the business. They are supposed to also give the direction, long-term, short-term, of where the company should go. And of course they are assisted there by the supervisory board. Most of those are former top managers. And of course you have the shareholders, many of whose are the top managers of the investing companies, the insurance companies, and the pension funds, and what have you. And then, of course, you have the small shareholder, individual person with not much clout, but also his vote, of course, in the meetings. Now, how is the salary of the top management determined? Here, I think the answer is still the same, because you can't separate the contribution of the capital to total profit, the return surplus of the operation, and the work of the manager and the entrepreneur, the one who gives the direction. How would you be able to say this is so much of the profit is attributable to this function and so much is attributable to that function? So we have the same situation as before, that, at least to my mind, you can't, what it has to be is what is judged to be reasonable by top management themselves, supervisory boards, and main shareholders. Specifically, to put a little bit of number to it, take a multinational with a operating surplus profit of $10 billion, euros. What is the reasonable remuneration for the CEO and other executive officers? Whose, according to, the principles of the market and of the whole system are, to whom the 10 billion to a large extent is attributable. Is it 1%? 100 million? 2, 3, 4, 5? Who knows? It's again what, in the end, the shareholders accept as end. Ooh, already, really? Then very quickly, special position of management is that they are managers, so they have a salary situation. They're not taking the risk that the capital providers take. They do the entrepreneurial function, which is defining and producing the risk of the whole business. But as we know, normally top management has a salary and exit clauses in terms of disagreement about the direction of the enterprise. And the level of their payment is nonetheless brought in relation with the absolute amount of the profit of the whole company. That produces what I think to many people gives the uncredible situation of top-level pay compared to what those who are experts and have a discernible productivity level are getting. Conclusions, these are, and now, I will tie up a little bit with the earlier thing. The bigger the companies grow, the bigger the turnover, the bigger the surplus in the end, and the bigger the pay of the 1 or 2, 3, 4 who are to a large extent held responsible for that result. And this, I don't see how this can be changed. It's the logical outcome of the way the things are organized. Can I have 1 minute for my final? Yeah, just 1 minute. Democracy and market forces. There I see 2 problems. To be relatively, I'll be as short as possible. You have the political inequality. To my mind, one of the major things causing political inequality in Western countries, and perhaps also in others, is lobbying. This is new to me, was new to me also. You have, of course, citizens with voting rights, and third parties without. Now, citizens with voting right, of course, should be able to lobby for because they are the ones who have the vote, and they are, according to the system, thought to be the determining quantity who decides what happens in the country and what the government does or does not. Then you have the parties without voting right, and they can, of course, also influence parliament and parliamentarians and government because they have relevant information about how things work, what can be done, and so on. And they do that, and the US has a nice law about lobbying in which all that is made public by these third parties is not lobbying. Lobbying is what is not made public. In the UK, I just read that there is a law coming up that will provide the names of those businesses that will lobby. The law is not yet there, and it seems difficult to get it through. That law will not force them to tell what the lobbying was about. To my mind, lobbying should not be, and I don't, this goes to my, well, feeling about what a democracy is. Lobbying action is okay, but it should be public. So all communications between businesses and other interested parties and parliamentarians or government should be just made public, word by word, comma by comma, what you have. If there are secret things, then okay, you can talk to the relevant parliamentary committees, but not to one individual, one party, and then not make clear what you have been saying to others. Then, very short, I see two problems. I also already mentioned it with the good function of the democracy. What you need is information provision to the public. That is, that goes according to the official principles of journalism, which was you have the facts and you have opinion. That is a principle that is disappearing more and more, and well, in the UK, again, the Murdoch, Cameron, and so on make clear enough what should not happen, one would think. Academia, at least in the economic sector, economists have a very high tendency to also have a political opinion, and often to suggest that their economic scientific views support their political opinion. Of course, in a market, this is no problem, but for academia, I don't know whether that's what we should strive for. And then, of course, you have research that you simply buy. I mean, I don't think that the tobacco industry and the asbestos industry are, say, controversial examples of industries that have made clear that whatever they did, it was never harmful. So what can be done here, I don't know. In the press, neither. How do you get back to this fact opinion? How do you get to academia who try or say at least more explicitly, this is bought by somebody, or this is my opinion, and I have a nice theory to it. I don't know, but I see this going on and on and on. If you add that to what's described in the book I mentioned, you do not become very optimistic. Thank you very much.
Thank you very, very much, Mr. Korteweg.